We're looking at the topic of cash dividends and stock splits. What are the effects of paying out a cash dividend, and what are the effects, and really what is a stock split? How does that affect the company's financials, and how does it really not really affect the company's financials? We'll talk about all of those things in this little video. Alrighty, so these are topics related to earned capital accounts. Remember, we're not talking here about the other major flavor, contributed capital. Here we are talking about earned capital accounts. And so dividends, we've already talked about this, well, for several modules, right? Dividends can be paid in cash, well, sometimes in other assets, sometimes in additional shares of stock, also known as a stock dividend. But conceptually, of course, we know what a dividend is, right? It is management's declaration of the amount of profits, of earnings that will be shared with the rightful owners of those earnings, which is, of course, shareholders, owners of the company. A stock split, on the other hand, is something entirely different. A stock split is when additional shares of stock are distributed to existing shareholders. So let us talk about that in a subsequent slide here. You can see here in 2022, our example company, Johnson & Johnson, reported dividends of $4.45 per share, which totaled up to be, well, an awful lot of money, as you can see there, right? And the company reported that it increased its dividend in 2022 for the 60th consecutive year. Think about what that means to investors and long-term holding prospects of J&J stock. If you know that this company has had a pattern for 60 years of every year incrementally increasing the level of dividend, the level of earnings that it is sharing with shareholders, right? That is an income stock. And there are many reasons why investors, as they think about diversifying their portfolio, would want to own an equity that paid a regular dividend, not only paying a regular dividend, but a dividend that continues to increase over time. All right, so two analysis metrics that you need to be familiar with, and this, of course, not just for the homework, right, but just for your analysis as well, those being the dividend payout and the dividend yield. And you can see there how each of those are calculated. Each of those begins with the common stock dividends per share. And with regards to the dividend payout, it divides that by the basic earnings per share. Okay, so that's one metric. The dividend yield then takes that same numerator, common stock dividends per share, and divides it by the current share price. And you sort of see here what each of these is really describing. The dividend payout is attempting to describe the proportion of the company's earnings that got paid out as dividends, right? So what actually got paid out. And as you can see here in 2022, that's 65% of their earnings got paid out as a dividend. That's healthy. And then when you talk about a dividend yield, what are you really trying to describe? You're trying to describe the relationship between dividends and the current market value of the company's stock. To what degree is the dividend then factored into or considered by the investment community? You can see here that the amount of dividend paid accounts for 2.5% of the current market price at the end of 2022. On this slide, you can see a description of the financial statement effects of paying out dividends, right? Which is pretty straightforward, right? I mean, it's simply a cash expense, and the offsetting entry will be a reduction of earned capital, or more specifically, retained earnings, right? And so you simply reduce cash and retained earnings by the same amount, as you might guess, for a particular payout of dividends in any particular period. Notice that dividend payments don't really affect net income. They directly reduce retained earnings and bypass the income statement. Okay. Now, the second topic is this whole idea of a stock split. And stock split happens when a company issues some level of additional common shares to its existing stockholders. Typically, the reason why a company will decide to do a stock split is in order to reduce the typical share price in order to make it more affordable to more investors. Let me give you an example. If, for instance, a particular company, whether that's Apple or Berkshire Hathaway or one of these large, popular, stable companies, their share price over time continues to increase to the point that maybe one share now costs over $500 a share, then you have really made your, or not, you haven't made it intentionally, but your stock price has risen to the point where it is not necessarily affordable to the smaller investor. And so simply splitting every share of stock from one share into two, right, a 2-for-1 split, would essentially dilute the pool to the point where every stock, rather than being $500 a share, is now $250 a share, therefore making it far more affordable, at least to individual stock purchase. As you might guess then, really, you're just doing a trick with math, right? It's not really a monetary transaction, as in the third bullet point. There's no financial statement effects. It's not really a cash transaction, right? And so what ends up happening is the company must disclose when they split what is the number of shares outstanding for all the periods presented in the financial statement. And so what ends up happening is that companies end up having to reduce the par value of the stock proportionally with your split. And not all splits have to be 2-for-1. You could do a 3-for-1. You could be some fractional thing, right? So, I mean, I'm just using a 2-for-1 split as an example for the math. But any ratio you could, in theory, use as long as you report it on your historical financial statements appropriately. So you can see here that a common way to perform a stock split is to declare a dividend payable in company stock. And so what you end up doing, rather than sending a cash check, is you are simply sending fractional shares of stock to those owners. And for those of you who have investment accounts, you realize that even if this is not the case, you can automatically set up your investment accounts to choose to take any earnings and just automatically reinvest them in fractional shares of stock. But nevertheless, here we're talking about a stock, a dividend paid in stock, which will, of course, then add to the number of outstanding shares, right? And so what ends up happening is the stock's par value per share are then unaffected by a stock dividend. In fact, in February 2022, you could see that the Alphabet Corporation, right, the parent company of Google, announced a 20-for-1 stock split in the form of a stock dividend. And after the split, the outstanding shares increased 20 times. Yeah, there are real examples and uses in the real world. But the thing to take away from all this, of course, some 3 things you might think about. One, if a company is continuing to pay dividends, if it's not just a one-off or an occasional thing, then that is a strong signal to the market that this is really a company that you can rely on, that growing dividends means you are counting on earnings to continue to rise, and that is why you're continuing, in J&J's case, for 60 years to increase every year the level of dividend. And that is typically a stronger indicator to the market than what management says during their commentary in the financial statements, right? Their earnings guidance. Another thing to note is that when we talk about stock splits will influence perceptions, but they're not really part of your fundamentals, right? They don't change total market value. They don't really alter your financial statements. They are a behavioral or market access strategy, not a performance indicator. And then the other thing to note, finally the last thing here, right, that if you choose to pay dividends, right, then, well, that's a trade-off between keeping the money in-house to fuel future growth. What's more important to you? And therefore, from the market's perspective, you do need to pay attention to the dividend payout ratio and the dividend yield ratio to really see over time how is this working, what percentage is chosen for growth, and is the company continuing to remain a real growth machine. So I hope this is helpful. Again, this is our deck number 4. We have 2 more left in Module 8, and we will see you in the next lecture.